Good afternoon, everyone. Thank you so much for joining us today. All of us here at Apriem Advisors hope you are safe and well during these unprecedented times. We are so excited to welcome you to the first of our four-part series titled Apriem Portfolio Construction. I am Rhonda Ducote, President and Senior Wealth Manager, and I, along with Josh Garland, one of our financial advisors, will be your host today. We will be discussing part one of the series, Building Blocks of Portfolio Management. So, once you determine your financial planning goals, how do you set up your investments to reach these goals? And why is asset allocation and diversification so important? Apriem focuses on a goal-based investing and has crafted its various strategies around our client goals. I will now turn it back over to Josh, and he will be introducing our speakers today from our investment team.
Thank you, Rhonda. So I'm really excited about today's topic, and I'm excited to get to introduce our two speakers. First is Benjamin Lau, who is our Chief Investment Officer here at Apriem Advisors. Benjamin graduated from UC San Diego in 1998 with a BA in Economics. He later went on to become a Chartered Financial Analyst charter holder. He has over 2 decades of experience, and Ben first got started at Fidelity Investments way back in 1998, and he started with Apriem in 2002. Ben has most recently been interviewed by the Wall Street Journal, giving his insights on the recent stock market meltdown amid COVID-19 fears, as well as discussing U.S. stock optimism and valuation on trade. I know that I speak for everyone on the team when I say we feel very blessed to have him at the helm of our investment ship here. And right alongside him, we have Ahmatovic, who is a financial analyst for us here at Apriem. He works directly with Ben as his right-hand man. Alan graduated from CSU Fullerton in 2015 and earned his BS in Business Administration with a concentration in finance. Alan recently became a Chartered Financial Analyst as well. Alan got his start in the industry as an intern at Waddell & Reed in 2014 and joined Apriem in 2017. He's most recently been interviewed by Investor Business Daily on exploring investment opportunities amid the COVID-19 pandemic. Now, as Ben and Alan begin to take us through the series, I just want to take a minute to reiterate the fact that we've really got a lot of content that we want to cover here, and we have a wide range of experiences joining us for our calls, from the brand new investor to investors that have been doing this for decades with their own personal experience. So this is why we've broken the education up into 4 different parts. Today's really meant to be more basic and foundational. It's just like math. If you think about math, you have to start out with the basics before you can move on to that more advanced calculus. So we want to make sure that everybody gets the basics down really solid, so that as we continue to move on to more advanced concepts moving forward, these foundational pieces are there, and then we can continue to get further and further into the weeds. So with that, Ben, Alan, I'd like to thank you both for taking the time to help educate us through the course of this series, and I'll turn it over to you.
Thank you, Josh. Thanks for that great introduction. It's really flattering. I'm really excited for this series that we're going to start off today doing, and as they're mentioning, there's the first of a 4-part series that we're doing about portfolio construction. Portfolio construction is a real passion of mine, obviously, because I do it here at Apriem, but it's really been something that I've been following for a long time. You know, I get a lot of questions from my friends, especially recently, about what's the latest hot stock tip or what's a good day trade stock that they can gamble on. And it's funny because I always get these questions, but I always remind them what I do here at Apriem, and for all of our clients that are listening, is not gambling. We have a process that we have in place to invest client dollars. And it really starts off with a blueprint. Where are we going and what we're trying to do here? And the blueprint really starts off with this asset allocation. And so that's why we started off this whole process of this series with asset allocation, the blueprint of the future for you. So we're going to start off with asset allocation. What is asset allocation? What is its purpose? How do we do it here at Apriem, which is quite important? And then most importantly, why? Why does Apriem do asset allocation this way?
Thank you, Ben. Yeah, so to get us started today, kind of like Josh mentioned, we're going to get started with the basics and then work our way up from there. So the first question that we want to answer today is, what is asset allocation? So from its most fundamental level, asset allocation is the distribution of our wealth across a range of various asset classes. But really, to sum this up into one word, it's as simple as diversification. It's about not putting all of our eggs into one basket, and it's about spreading our nest egg across a range of various asset classes.
Thanks, Alan. That's good information. So can you tell us now what asset classes are and what are the different types of them?
Great, yeah. So asset classes are really just a technical name for different types of investments. So from a high level, Apriem breaks asset classes out into 5 broad categories. So the first one is equities. So these are stocks. So these are ownership of a business. And stocks are kind of broken out into a few different subcategories. The first is large cap versus small cap stocks. So this refers to the size of the companies. So large cap stocks, you can think of like the large well-known companies we all know, Amazon, Apple, Google. And small cap stocks, a few good examples of those would be a company like BJ's Restaurants, which is smaller, more regional restaurant chain, and iRobot, which is the robot vacuum cleaner company. Another way to think about stocks is domestic versus international. So in the US, we have our own stock exchange. Those would be domestic stocks. Stocks trade on the New York Stock Exchange. And then there's stocks in developed international markets. So those are markets like Europe and Japan. And then there's stocks in emerging markets. Those would be places like China and India. And so the second broad category we're going to go over is fixed income. Fixed income, these are bonds. And what are bonds? Bonds are loans. So when you buy a bond, you're effectively loaning money to the entity that you purchase it from. And bonds are really broken into a few subcategories on their own. The first is government bonds. So those are like US Treasury bonds. Another good example would be municipal bonds. So those are bonds that are issued by state and local governments, which are generally more tax efficient. And then a third broad category would be corporate bonds. So those are bonds that are issued by corporations to grow and expand their business. Now the third broad category are commodities. So commodities are essentially economic inputs that are used in either the manufacturing of goods or the execution of different types of services. Commodities are broken into 3 subcategories. The first is energy. A few examples of this you can think of are oil and natural gas. The second would be agriculture. So you can think of like corn, soybean, wheat as a few examples. And the third would be metals. So that's copper and gold are a few popular examples there. The fourth broad category is real estate. And so real estate, really what we're referring to here is property and buildings. And this is broken down into 4 subcategories in itself. And the first is residential real estate. So that's things like single family homes, apartment complexes, any type of real estate where people live in. The second is commercial real estate. So this is things like office buildings, skyscrapers in big cities are a few good examples of that. A third would be industrial real estate. So that's warehouses, factories, different types of property and buildings that generate some sort of business typically. And then the fourth is land. So just raw vacant land that can be used to build upon in the future or make other various types of investments. And the last category we're going to cover is cash. So that's simply just cold hard cash in your bank account that you can use to make investments now or some point in the future, or just to hold as a preservation tool. So that leads us into our first trivia question of the day. And so our question is, what is the first commodity ever traded on an exchange?
All right, and so what I'm going to do is I'm going to go ahead and launch this as a poll. So everyone should see your screen change slightly, and you can actually select which of these different commodities you think was the first that was ever traded on an exchange. Go ahead and enter it now, and once we get to about 70% of total votes in, I will go ahead and close the poll.
So the correct answer is D, rice. So fun fact here with this one, so humans have actually been trading in commodities throughout our entire history. And the first commodities trading actually goes as far back as 8500 BC, where people traded agricultural commodities to help preserve their prices. But the first commodity ever traded on an official exchange was rice in early 1700s Japan.
Thanks, Alan. That was a fun fact. So, okay, Ben, I'm going to direct this question over to you. Now that we know what asset allocation is and the various types of asset classes are, can you tell us what is the purpose of asset allocation?
Well, Rana, that's a great question. Real simply, it's to smooth out the ride throughout the business cycle that we get. And for many of our long-term clients, you'll notice the chart that we have on the screen right now, the typical business cycle that we all learn in school, or at least I learned in school. On the left side, it starts off with the early stage of a business cycle, right, where things are getting better. The economy is improving, sales and profitability are rising, inflation is low, so interest rates are low, right? And so that requires a different type of style investing. And then on the all the way to the right-hand side is the late cycle or the recession part of the business cycle, right? Probably what we're in now. And obviously investing in that time frame requires a little bit different style, right? And maybe stocks are underperforming initially before the recession or during the recession. Maybe bonds are a better place to be because interest rates are falling, and so they're pretty safe investment. And so the difficulty that we have here at Apriem is that we just can't invest for one part of the business cycle, right? When clients hire us, they hire us for decades at a time throughout their whole life cycle. And so we go through this business cycle, we can't just invest in it, so we need to come up with an investment strategy that can make it through the whole business cycle and to really smooth out the ride and just participate. And that's why we try to have investments in several asset classes that really help smooth out the bumps along the road that we always will get.
So Ben, actually, I have two questions for you here before we move on. So one, when you look at this, my initial thought is, does the market just continue to follow the cycle in one linear path?
No, it doesn't. That's a great question, Josh, and especially more so on the early and the recession stage, but that mid and late stage cycle is not very linear, right? And we can vacillate between those two areas for quite a while. And we think about just in the past history, right? Especially since about 2016 after the presidential election, right? We were coming into the election cycle at the end of 16, things were slowing down quite dramatically. Remember when oil prices were falling that time, and it was slowing down the whole economy. It was actually the oil crisis was spreading across the economy. And then after Trump, and then after some of the stimulus that Trump offered, we think that the economy actually re-accelerated, got stronger. We recovered from the energy crisis. The tax cuts helped the economy actually pick up and gain some momentum. And so we can vacillate between that mid and late stage cycle quite a bit. And that's where we spend most of the time in history is in those mid and late cycles. Okay. If you actually look at it, the early and recessions are actually pretty short.
Okay. All right. So basically understanding that we can kind of jump around in all different stages of the business cycle means we don't really know what's coming next.
Mm-hmm.
Right? And so I think that helps us to understand even more the importance of that diversification piece of the asset allocation and the fact that we don't know what's going to be up or down moving forward because we don't know where we're going to be. Mm-hmm. So now that we know what asset allocation is, we know why it's important. Let me jump into the weeds a little bit and ask you, how do you and your team, how do you guys think about asset allocation? How do you decide how much to allocate into those different types of assets?
Well, that's a great question, Josh. And really, here at Apriem, we have a pretty simple saying here: keep it super simple, right? And so what we focus on are three asset classes where we really think we have a competitive advantage that we can add value to our customers. And so the three asset classes are here listed below: stocks or equities, fixed income or bonds, and then cash. For equities, we really use equities, and there's a lot of different types, as Alan was mentioning, but we really use equities for long-term growth. This is one of the few or only asset classes that actually can beat inflation over time. So we really think that's the best place to be. And when we look at equities, we're not day trading equities or buying unprofitable companies. We're really looking to take business ownership in these companies to be a long-term investor. So we look for great companies with a competitive advantage and very solid cash flows. On the fixed income side, too, we're not as aggressive on the fixed income side, right? You can get very aggressive bonds in here that can be quite volatile. We really view bonds or fixed income as the preservation side of the portfolio, really to help during times like the last recession or earlier this year, right? And bonds have a nice benefit of adding some additional income to your portfolios. And then cash is cash. Cash is just, as Alan liked to say, cold hard cash. It's really our liquidity bucket. And so in this case, this is important to note that we're not reaching for yield here, right? We want something that's safe, secure, and liquid. But the question is, your question, Josh, is how do we mix these up, right? How do we combine all three of these asset classes? And there's no one size fits all. it really depends on each individual client, right? So a hedge fund might have a different time frame and different goals. A pension fund with pensioners has a different sort of goals, and a retiree might have a different set of goals than a 28-year-old Facebook executive that is still working. And so that's why it's so important and it's so vital that Ron and her team reach out to all of our clients and discuss their situation with every client out there, because each client is unique and different. You have different needs, different timeframes, different goals. And that's why it really comes down to Ron and her team.
Yeah, that's right, Ben. So really at Apriem, our job is to construct a portfolio for you, right? So for us, it all goes back to the financial plan. So the first step is to create a financial plan. And here you would sit down with our financial planning department. You'd lay out your current asset base, your cash flow, and your long-term financial goals. And then based on your asset base and cash flow, we're able to back into an average annual return that you need to earn on your investments to meet those long-term financial goals. And so the more ambitious the financial goal is relative to your current asset base and cash flow, the higher return you're going to need. And vice versa, the less ambitious the goal is relative to your asset base and cash flow, the lower return you're going to need. So as we all may have heard, though, at one point or another, the first rule of economics states there's no free lunch, right? So investing comes with risk. So that's why we must factor your risk tolerance into this equation. And so your risk tolerance is really made up of three primary factors. The first is the time horizon of your financial plan. The longer your financial plan goes out into the future, the more risk you're able to take with your investments, because you have time to make up for the fluctuations in markets. The second key factor is your current dependence on the portfolio to meet your income needs. The less dependent you are on your portfolio today to meet your income needs, the more risk you're able to take with that money. And then finally, the third one is just simply your willingness to accept risk. So some people are able to deal with the ups and downs of markets, and some people really just can't stomach it. So it really depends on the person, but it's important to know that about yourself because it's really an important factor to add into this equation. And so when we combine these two factors, we're able to determine a suitable asset allocation that meets your needs. So now to dig a bit deeper, here at Apriem, we utilize 5 different asset allocations that cover a range of different expected returns. And so these are highlighted on the top part of the chart with the gold bar surrounding them. And so quickly to kind of go over them, the first one going from left to right is 100% stocks, 0% bonds. The next one is 75% stocks, 25% bonds. The one in the middle is 50% stocks, 50% bonds. The next one's 25% stocks, 75% bonds. And then the final one is 0% stocks, all fixed income. And then the green bars that you see below each asset allocation, this represents the long-term average annual return that we expect each asset allocation to generate over the next 30 years. And so here you can see the asset allocations that have more stocks are expected to generate higher return. And then the asset allocations that have less stocks are expected to generate less return. And so really the idea here is to figure out the return you need to earn on your investments to meet your financial goals, and then to select an asset allocation that most closely matches one of these returns. But as we just mentioned earlier, investing comes with risk, so it's not that simple. But there's a few different ways to think about risk. For this purpose, we're going to look at the potential worst case scenario that comes with each asset allocation. These worst case scenarios are the red arrows that you see below. These red arrows represent the losses that each asset allocation experienced during the Great Financial Crisis in 2008. So as you can see, a 100% stock portfolio suffered a 56% drawdown in the Great Financial Crisis of 2008. A 75% stock portfolio saw a 45% drawdown. A 50-50 portfolio saw a 33% drawdown. 25-75 portfolio saw a 20% drawdown. And then an all bond portfolio saw about an 11% drawdown. So kind of similar to the return side of this, the more stocks you have, the higher return you're going to earn. Also, the more stocks you have, the more potential risk that you face. So that leads us into trivia question 2, which I'll lead to Josh.
Yeah, actually, I think this is a very well-timed trivia question because this question really has to do with asset allocation. So for those of you that are on the call with us, I'm going to go ahead and launch our poll. All right, the question is, when did a 50-50 balanced portfolio, so 50% equities and 50% bonds, when did it recover from the losses that it suffered during the 2008 Great Financial Crisis? Go ahead and log your votes right now, and we will give you guys 1 minute to get them in. Okay, that puts us at about 14% of the votes are in. You guys have about 15 seconds left to get your votes in before we close the poll.
Just a little bit of history, right? The markets really peaked around late 2007, around August, October timeframe of 2007. Started declining slowly throughout first half of 2008, and then 2008. The last half of 2008 was really horrible, and the markets bottomed in February of 2009. So that was a rough year and a half.
A long 18 months, yeah.
A slow grind to the bottom there. Okay, we are going to go ahead and close our polling now.
Correct answer is April 2010.
Yeah. It's surprising that with the limited losses that a balanced portfolio suffered during the Great Financial Crisis, it was really much quicker for a balanced portfolio to recover back to their highs. And it really took about a little more than a year. The funny fact is that March 2012, that's when a 100% equity portfolio had to recover back to their highs.
I think that was great.
That's great, thank you, Ben. And that's a great lead-in into our next slide here. So really, these drawdowns can be really painful, right? But history does show us that the markets do tend to recover and move higher over time. And so this is a good chart that I think does a great job of depicting that. So here, if you're looking at this chart, the orange line depicts a 100% stock portfolio, and the white line depicts a 50% stock, 50% bond portfolio. And as you can see, despite the severe drawdown that both experienced in the Great Financial Crisis, right around that 2008 area, more specifically 2007 to 2009, you can see that investors who stayed the course and stuck through it ended up doing just fine over time. So really the key takeaway here is, before we start investing, we really need to ask ourselves, are we able and willing to accept the potential losses that come with our chosen asset allocation? Because we have to remember, these losses are never permanent until we actually sell. So really the goal is to select an asset allocation that you feel you're going to be able to stick with through the ups and downs and through really the long term. And it's important that that asset allocation most closely matches the return you need and your risk tolerance metrics that we discussed earlier. And really, if there is a material difference in these factors, then that's where it's important to sit down with your advisor and so we can have these discussions, kind of reconcile those differences, and find a middle ground that works.
So I think that's really good. I think just to summarize everything we've gone over so far. So it sounds like what's happening is the process would be you start with your financial plan. Your financial plan helps you to determine what your required rate of return is to achieve your goals. Then we need to add that to your personal risk tolerance levels. So sometimes this is hard to identify, but they have to work together, because the idea is to allow you to get in a position where you can stick to the plan. And then that eventually leads into what our asset allocation is. Now, do you think that you could help to describe what the additional value is that's provided beyond just constructing that initial plan from the start?
Right. Yeah, so that's a great question. So really at Apriem, our goal is to make you a successful investor, right? So we really feel that the value that we provide is geared toward that, and we break it down into two separate components. The first is developing the plan and selecting an asset allocation at the onset of the relationship. But really we feel this is kind of the easy part, right? The second part, which is the more challenging part, is following through and sticking with it, and then making decisions that align with the financial plan and your asset allocation. And so we have a good diagram that kind of depicts this. And this diagram really tells us two things. Well, the first one is I can't draw. So there's a reason I studied finance in school. There's a reason Ben studied finance in school. We're not artists, so we deal with numbers. But the second, more important, is this is really, you can really see that the combination that's required to preserve and grow our wealth over the long term is developing that plan and is sticking with it through all the ups and downs. And so in order to do that and follow through with the plan, it's important to select a specific investment strategy that aligns with the asset allocation that you need to reach your goals. So at Apriem, we have 3 different investment strategies, and they each come in one of the 5 asset allocations that I mentioned earlier. And these 3 strategies are further categorized into 2 higher level categories. These are passively managed and actively managed. And so the passively managed strategies, what that means is if you take a 50-50 portfolio, for example, it's 50% stocks, 50% bonds. We're going to always stay at that asset allocation no matter what's going on in the market. Whereas in the actively managed strategies, we have the ability to adjust that asset allocation depending on what's going on in the market. So a 50-50 stock bond portfolio could be adjusted at one point or another. So the first strategy that I'm going to go over now is our passive index strategy. So this is our one passively managed strategy. And so this strategy utilizes ETFs on the equity side and mutual funds on the fixed income side. And really the goal is to generate market-like returns at a low cost over the long term. And just keep you invested, try not to add too much volatility to your portfolio, and really just try to match market returns. The second one, which is our first actively managed strategy, is the tactical index strategy. So this strategy utilizes ETFs on the equity and fixed income side, and it seeks to provide downside protection. So it looks to exit the market when the market's doing poorly, and then enter back into the market after it's recovered. And then finally, the third strategy I'm going to go over is our global allocation strategy. And so this strategy utilizes ETFs and individual stocks on the equity side, and it utilizes mutual funds on the fixed income side. And really at Apriem, we consider this our core strategy. It's our oldest, our flagship strategy that we rolled out back when the firm was founded in 1998. And it's the strategy that we put a majority of our research and our resources into today.
Great, thanks, Alan. So the last trivia question of the day. Since 2000, which equity asset class has generated the highest returns? And so remember, Alan was going over the different equity asset classes previously, but here are some of them. Since 2000, which has generated the highest returns? A, small cap U.S. equities. B, emerging markets. C, large cap U.S. equities. Or D, developed international equities.
All right, very good. I have the poll on the screen for everyone, so please feel free to submit your votes. Ben, would you like to share with us what the correct answer was?
So this is over 20 years, right, of performance, and we've really broken it the last 20 years. In the first 10 years, which some asset classes did a lot better than the second 20 years, in which the second 10 years in this period was really dominated by U.S. large cap equities, right? The NASDAQ or the tech stocks we all talk about. But over the course of the whole 20 years, the best performing asset class was small cap equities, followed closely by emerging markets And U.S. large cap equity was actually the third best performing equity class over the last 20 years. And then last was U.S. Developed International. So why does Apriem do all this, right? Apriem, our goal here is to really practice goals-based investing. We are here to invest for you. And as simple as it sounds, it's really tough. And that's why it's so important that we like to meet with you. We have Ron and her team have a team of financial advisors and financial planners meet with all of our clients regularly. And we're really trying to invest for you because we really try to understand your unique circumstances, goals, and situation. And so the most important thing is we can do is really come up with a solid financial plan, understand what your needs are, and then really work with the asset allocation to meet those financial plans. And so Tony Robbins, the great motivational speaker, had a great quote here. The difference between success and failure is not which stocks you should buy or what piece of real estate you buy, it's your asset allocation. I think those are really wise words.
Thank you, Ben and Alan. I think that now is a good time for us to go ahead and get into some Q&A. First questions that we had here is, which of the strategies is the best? How would you guys address the question, which of the investment strategies we have is the best?
Well, that's a great question, but a tough one, right? And we have, everything you saw on the screen, there's about 15 different strategies that we run. The simple answer, as unfortunately Josh is the toughest one, is it just depends. It really depends on your situation. And again, that's why we have all of our financial advisors. We want them to meet with all of you to see what your situation is and match up what strategy is best for your particular situation. So it could be, some of the ones can be great for different times of your life, and certain ones can be better for different times of your life.
Yeah, it's also important to point out that, some strategies are going to perform better in different market environments, and some are going to perform better in other ones. So it's really not a matter of performance, we think, or at least short-term performance. It's more about finding one that's going to fit your needs over the long term and really help you stay invested and stick to the plan.
That's awesome, Alan. Thank you. And Ben for answering that. A great question. Here's another one. It says you have 3 strategies, technical, global, and an all index. Which is the graph depicting?
Which graph?
So it's
the one on page 12.
Yeah. So that graph isn't depicting any of the strategies. That graph is just depicting a model 100% stock and 50% stock, 50% bond portfolio. So yeah, it's not how any of our strategies performed during that time. It's not taking any historical data of our strategies or anything like that. Yeah, it's just used for illustrative purposes. Right. Yeah.
Perfect.
So I'll go ahead and take the next question here. Next one that I can see on here is it okay if I change my strategy along the way?
Of course. Yes. Again, this is, we're laughing about this, but this is really why we have advice, because I can't remember a single client that we've had, and I've been here for almost 20 years now. I can't remember a single client that we've had that stayed in the same investment strategy the whole time. Their strategy is going to change because their life changes, right? And so whether you're an accumulator or you're recently retired or a life situation happened where you sold a piece of property or sold a business, it changes over time. That's why it's so important that you work with your financial advisor, preferably be here at Apriem, to come up with the best asset allocation.
Yeah, I mean, I think it's okay to change strategies if there's a real solid fundamental reason behind it. But the one thing I would say is it's not wise to change strategies if you're just looking to chase performance. If one strategy is doing better than another, over the last year or something like that, we don't really consider that a good reason to shift into that strategy.
Yeah, because there's just so much noise coming up. Mm-hmm. With everything we hear, COVID, right? What we're going through right now. What's happening at the end of the year? Oh yeah, the election, right? We're having all these things that could drive a lot of noise, but Alan's exactly right. Try not to let the noise dominate your decision.
Yeah, I think when you're changing strategies, it's really about a life-changing event, as Ben mentioned. Meaning, giving you an example, we've had several clients this year retire, and they needed to change strategies because now instead of going from working and getting a paycheck, they now they're retiring and they're now, relying on their portfolio for additional income to supplement their income with Social Security and a pension. So that requires a change from a growth portfolio, maybe to a balanced portfolio or to a more conservative portfolio that will generate income. Another life-changing event would be maybe the loss of a spouse, the death of a spouse. That's a life-changing event. And it could even be a divorce if you're splitting up assets and you each have different goals going forward because you're not together. So I think that it's a great question. It comes up quite a bit, but I do agree with Alan that if you're chasing performance, it's really that's not a reason to change strategies per se. It really goes back to your goals, your financial plan, and talking to your wealth manager on a regular basis, and that's what we really encourage here at Apriem.
Yeah, I want to jump in here also because I think it's really important, especially based on the topic of the presentation that we're going through today, is that there's a difference between strategy and asset allocation. And I think that your asset allocation changes over time naturally. When you're younger, you're more aggressive, you take on more risk. As you grow and you accumulate wealth over time, and we get closer to retirement and our time horizon shortens, we move to less risky assets in our asset allocation. We start to make that shift as time goes on, and that's a very, very natural part of the financial plan or the financial life, right? Whereas when it comes to a strategy, there's lots of different ways that we try to achieve returns, right? Maybe are we investing in commodities? Are we looking to be, to deal with advanced options trading strategies or whatever these different types of strategies are that we're trying to generate returns? And so I think it's good to think about the difference between, when we say strategy and changing your strategy, it's not necessarily the same thing as adjusting your allocation, as your life changes. So,
Great question. So I think here's a really good one. I'll throw this out to Benjamin. With all the uncertainty in the world today, what is Apriem's outlook for the remainder of 2020? That's a loaded question.
That's a little bit of a loaded question, Rhonda. What uncertainty?
I'm uncertain that we have an answer for that.
Right? I mean,
I'm certain we don't.
Could you imagine me reviewing everything that we've been through in 2020 a year ago, right? It would sound crazy if I were to talk about everything that we've been through, and we just finished the first half of the year. It's gonna be volatile, right? We have a lot of things going on besides this. What's going on with COVID right now? I think the market is clearly dominated. I think the biggest factor in the market right now that's dominating every other factor right now is clearly the Fed, right? What Mr. Powell and the Fed is doing in terms of interest rates and in terms of really expanding the Fed balance sheet to an unprecedented level, really due to COVID. Obviously, I think we all know that we have a presidential election coming up later this year. Yeah. And the polls are going back and forth, and I think that's going to add another layer of complexity and volatility to the market, let alone all the House and Senate seats that are coming up too. And with that said, the markets are pretty near highs, right? We have the S&P near record highs. Bonds are pretty much at record highs too, with yields at an extremely low level. I really think what's going to happen for the rest of the year is just more volatility. I think a lot of people say that. But are the trends that have persisted and the trends that have caused this rally from March 23rd this year, are those trends going to continue? Are we going to continue to see improvements in the unemployment situation in the economy? Maybe hopefully that's due to the improving COVID situation. Are we going to get an election outcome that's going to be resolved relatively quickly? If those trends that have caused this turnaround to happen continue, I think the market's going to do relatively well, but I think it's going to be a bumpy ride for the rest of the year.
Yeah, I want to comment on this too, because I think there's outlook, and there's our outlook, what our team thinks is going to happen, and you're going to turn on the TV, and the TV is going to talk about what they think is going to happen. I think it's really, really important that, we can spend a lot of your talking about what we think is going to happen, but as far as the way that the investment decisions are made, that's based on the way the strategies themselves work versus being based on trying to make predictions on where things are going to go. It's the difference between being an investor, right, where we're investing in something we want to own that we have faith will grow in the long term, and being a speculator, where I'm making a bet and hoping that I'm correct about where things are going to go and how that bet's going to pan out. Shall we move on to the next question?
Yes,
All right.
absolutely.
All right. So I'm going to read the next one. Let's see here. How do you choose specific stocks within a given group? Large, small, domestic, international, etc. And I'm going to put in a little plug here. Okay, we're in part 1 of our series. We're talking asset allocation today. I can tell you if you stick with our series that we will get into this in much, much more detail. I want to allow Ben and Alan to answer the question, but in part 3, I think we're going to dig into this very, very deeply.
Yeah, so don't steal your own thunder.
Yeah.
We'll keep it high level.
It is a shameless plug for our equity seminar that's going to come up on July 29th, I believe.
Yeah. So to give, I guess, a little preview to that. So, I mean, really what we do is we focus on high quality businesses. We like to buy them when they're trading at a significant discount to their underlying value. Right now, we mainly focus on large cap companies, just because large cap companies are typically the ones that have that solid competitive advantage in place that we think is going to last over the long term. So we don't really invest too much in small caps now, but that could change. As some companies come up and grow, they could, find their place in their industry or their market and really establish a competitive advantage. And at that point, we would like to take a look at them. But yeah, right now it's mainly large caps. And the other important factor is buying at that discount to underlying value. So we don't want to buy companies when they've already gone up. We want to buy them when their prices come down for a short-term or emotional reason. I think it's important to point out that the market could be very emotional at times. And so what we like to do here is we like to take advantage of when a company gets oversold, and it gives us a good opportunity to jump in and buy it at a good discount.
Yeah. Great answer, Alan.
That was a good answer. Any other comments, Benjamin, on that?
No, I mean, I think for some of our clients, they kind of know that the 3 main tenets of what we look for in a company, right? In a business that we want to be a shareholder in for a long period of time. And Alan's exactly right. We want a company that has a great competitive advantage. They're doing something different that no one else is doing. They're doing something that no one else can do in many cases. And because of doing that, they have a longevity to it, and they're not going to prosper or decline during different presidential cycles or different economic environments. So we want them to be able to last long periods of time. The second thing is that they want to be using that advantage to make money, right? As simple as it sounds, and we really view that as cash flow, whether it's in terms of free cash flow or higher operating margins. We really want them to be using that to gain market share and make money. And then the toughest part, obviously, is what Alan mentioned at the last, is buying those when they're at a discount. And so that's the hard part. But we'll be covering that at the equity session.
I think that was a great answer and a precursor to our number 3 series. So I think we have time for one more question, and then we have some closing remarks as well. So I think, this is always a good question, and it usually comes up every 4 years, and it usually has to do with a presidential election cycle. So you briefly mentioned it a few minutes ago, Ben and Alan, but this question is more, does it matter if it's a Democrat or a Republican that gets into the White House from our point of view?
Yeah, that's a
Another
loaded question, but you're right. It does come up either every 4 years or 8 years, but usually about every 4 years, right? And then let's not forget that every 2 years with the midterms. But it's a great question. It's a really important one, especially as we come to a very big election towards the end of the year. As we know, the markets are really dominated by a lot of forces, right? Not just politics, and politics is a strong force. But in recent years, the market has been dominated by company earnings, profitability, valuations. Fed policy is a big one. So the market is dominated by so many of these big macro forces that one single force it's really hard for one single force to dominate for a long period of time. So really don't think that politics of the White House is going to have one single important factor over a longer period of time, maybe for a day or so, kind of like we saw at the night of the 2016 election and the day after. But if you think about it, the market will be focused on a lot of things. I think the biggest factor continues to be the Fed and what stage of the economic cycle we're in. The presidential cycle is important, but I think the Fed still is the 900-pound gorilla in the room. but also in terms of politics. There's a lot going on in politics besides just the White House, right? We're looking at some seats that can be going back and forth, and what the split is between, what's going to happen with the House and what's going to happen with the Senate. Is the House going to stay with the Dems, and is the Senate going to stay with the GOP? And provide some sort of firewall to the White House. And I think that's really important. The biggest thing, though, at least from my perspective, and I'll let Alan get a few words in edgewise here, is that it's really going to come down to some sectors. Okay, I think the market as a whole is pretty dynamic, but it's really going to come down to a few sectors that are really going to dominate what politicians want to talk about. The good news is that it does seem like that all politicians really hate the same three sectors right now. And that's healthcare, banking, and technology stocks. And so they all, the Democrats and the Republicans hate them for different reasons, but it seems like they hate those three sectors right now. And so I think there'll be pressure on those.
Yeah. I would just say that, whatever does happen, this year in the elections and what goes on in politics in general, I think it can affect the markets, but it's typically short term. Typically, most of the things that you do see happen, they usually figure themselves out over the long term. And so I say that because we are, investing for the next, 5, 10, 20 years. So we don't want to be making short-term decisions, if we have a long-term plan. So.
Yeah, good point.
Well, great. I think that is all the time we have for all the questions. I hope you guys asked a lot of great ones. Thank you so much for your participation. I'm going to turn it over to Josh, and he's going to tell us a little bit about our upcoming events, and then we'll have some closing remarks.
Yeah, so I guess the last shameless plug before you guys leave. So we're going to flip forward to the next slide here, and we have the dates and everything listed for you right here. Perfect. Okay, so yes, today was part one. We laid out our blueprint for Apriem Portfolio Construction. So part two, this is when we start talking about laying the foundation for growth. Essentially, we're going to go through and talk a lot about bonds. Now, I've heard before that bonds are boring. I think you guys will be quite surprised at actually how complicated and in-depth bonds can be. And they are a very, very, very important piece of the puzzle. So when we get back together on July 15th, that is going to be the key topic of conversation, followed by part three on July 29th, which is kind of the fun one. Right, this is growing our wealth. This is where we're going to talk about equities. This is a piece everybody really, really likes to get into, but it would not be appropriate to get there first. We got to get the blueprint down. After blueprint, get the foundation in, and then we can really start talking about growing our wealth long term. Lastly, August 12th will be part four. That's when we're going to bring it all together. We're going to talk about what happens with your portfolio from a long-term perspective after we have the initial plan and everything in place. So. I hope you're all as excited as I am about that. You will receive an email here shortly with the links to allow you to register for part two. We will also make it available on our website. When you get to the homepage, we will have a banner up there in the next day where you'll be able to click and register for your links from there as well. And with that, I am going to go ahead and sign off and hand it over to Rhonda.
Thanks, Josh. Well, I just want to personally thank all of you for attending and participating today. This is our new normal with the webinars and seeing you all virtually. So I want to personally thank you for setting up your meetings with the wealth managers and staying in touch. Hopefully, we'll get to see each other in person again very soon when all this comes to an end. We hope you found it helpful and interesting. We would love any and all feedback. We're going to be sending out a survey electronically to each of you who attended in the coming days. So if you wouldn't mind taking a few moments to fill that out and giving us your feedback. We want to keep getting better, and we want your comments, for future events as well. So please get that to us if you can. With that, it concludes our webinar today. Have a wonderful day. Stay safe. Stay well. And if you need anything, don't hesitate to call or send us an email, and we'll get right back to you. Have a great evening, and take good care.
Bye, everyone.
Bye.
Bye.